How to reduce risk and maximize your returns. My name is Don Kaufman. This is a TheoTrade presentation. First and foremost, we are going to throw up a risk disclosure. We're not financial advisors nor a broker-dealer. Put that up there because many of you may remember back in the day, if you've been around a while or involved in markets for a while, I got my start. I actually got my start in Chicago as a trader, but I spent the better part of 15 years in the brokerage business. So here's a little bit about me. I'm a co-founder here at TheoTrade. I'll just give you some background. Listen, I started trading in the late 90s. 3 weeks out of college, I started trading. I was invited to come to Chicago. I started clerking on the floor of the Chicago Board Options Exchange shortly thereafter. I was actually managing a risk of a fairly substantial portfolio. Fast forward about 2 years from that, during kind of the internet boom of 2000, I was invited at the time to a startup firm. Nobody even knew what it was called. There was a handful of people working there. It was called Thinkorswim. And I actually built the education division of Thinkorswim over approximately a 7-year period. We then took the firm public. Eventually, we were acquired in 2009 by TD Ameritrade. I then went on to run TD Ameritrade's education. And at the time, we had 7 million clients. So we went from a few 100,000 clients to running education for 7 million clients for the better part of 5 years before finally hanging it up. I exited the public company, obviously, and we launched TheoTrade. So that's a little bit about my background. Again, starting as a trader. In fact, I come from a family of traders. So you'll see a couple of screenshots tonight may have Thinkorswim in that. That's not necessary, though, if you're not a Thinkorswim user. I get it. I've done a couple of different CNBC tours over the years. I continue to do a couple of broadcasts. Every other week or so. We actually do some TV slots here, TheoTrade. And here's a little bit about TheoTrade. We specialize in education for stocks, options, and futures. We're founded by professional traders and trading educators. Everybody here on the crew has a minimum of 15 years experience. A couple of us have a few decades under our belts. TheoTrade is here to help you mitigate the risks in the market. In fact, that's actually going to be one of the primary things we're going to discuss while learning a skill set that can last a lifetime. The other thing I like to mention right up front that very few people are aware, TheoTrade, it's not just Don Kaufman, okay? This is our crew here at TheoTrade. We are now 7 instructors deep, and I'll just give you a quick introduction. Jeff Bierman. Jeff Bierman actually worked directly with me at TD Ameritrade and Thinkorswim. Even prior to that, he was also the former chief market technician for TD Ameritrade. If anybody here has ever been on the Thinkorswim charts, let me know if you guys ever been on the Thinkorswim charts, because Jeff had actually kind of lays claim to over 300 of the studies on the Thinkorswim charts. He actually helped develop and put those into the platform. Next, we have Matt Williamson. He's a market neutral premium selling options strategist. If you're not familiar with market neutral, for the most part, okay, it's non-directional strategies. That is what he specializes in. Next up on the list, Corey Rosenblum. He's our senior strategist and resident swing trader. If you guys are into swing trading, trend trading, this is your individual. Next on the list, Brandon Chapman, CMT. Brandon also worked with us at both Thinkorswim and TD Ameritrade. In fact, Brandon was one of the primary educators at TD Ameritrade, and again, extremely knowledgeable individual. Literally, Brandon wrote the book, okay, for education at both Thinkorswim and TD Ameritrade. Some people will remember back in the day, there was a class that was offered through TD Ameritrade. Literally, the class cost $24,000 for an 18-month education. Brandon and myself and a few others, and Jeff Bierman was involved in this as well, literally wrote the book for those classes. Next on the list, Steve Slim Miller, 43-year veteran stock options and futures trader. I've actually known Steve Miller most of my life. Last but definitely not least, Tony Rigo. This is actually our intraday NASDAQ futures specialist. So if you're looking for a NASDAQ futures specialist, this is your individual. All right, everybody ready? Because we're going to jump head on into this. Again, we're talking about this evening how, again, to minimize risk. That's one of the first things we're going to get to, is talking about minimizing risk, kind of maximizing returns. But I wanted to start tonight on a little bit of a different footing here, because there's just been an incredible amount of news, and I'm going to start with just this. I'm going to start with bond markets. Ready? Okay? Because now we're gonna have some fun. All right, let's make sure everybody's tuned in over here. All right, we're good. So bond market says, not only is a recession coming, but the Fed will cut interest rates to stop it. Now, what I'm actually bringing up here, just to begin this session tonight, are a couple of very recent headlines. What we're going to cover tonight is a tremendous amount about reducing your risk. But one of the things that I want to kind of bring to fruition first is some of the risks that happen to exist or lack thereof. So this is, again, a couple of just really recent headlines in here. Again, this one happens to be from none other than March 25th, updated on the 26th. Is it recent enough for you? It's less than a week old. And Fed Fund futures were pointing, okay, to a quarter point easing on Monday. That's in the future. So for the most part, they're looking for a quarter point ease. On Friday, there was also a so-called inversion in the yield curve. And I think almost everybody here, how many of you guys tuning in tonight have actually heard about the inversion of the yield curve? Okay. I mean, listen, you probably at this point in time have to be hiding under a rock not to have heard about an inversion of the yield curve. Okay. A lot of people really don't know what it means. I mean, listen, it's the foremost indicator for a recession. Okay. And that's why I'm actually getting into it over here. But on Friday, there was so-called inversion to the yield curve, meaning very short rates. Okay. Short-term rates, like 3-month, got above the 10-year. Okay, that's it. Traders say the bond market may be overreacting. That'd be true. While stocks seem to be ignoring the recession warnings and fears, the Fed, okay, will have to jump in with one or more rate cuts to stop the economy from rolling over. Now, I love this because it's, a little bit of headline risk over here. Now, as this yield curve inversion occurred, this is the yield curve inversion. This is what the market's been doing. This is the spiders. This is the S&P 500 over the last 10 years. But I just wanted to zoom into that because right there, that's where the inversion of the yield curve effectively happened. Now we're having fun. All right, next. This time is different. For the yield curve, they said that the last time around. So Bernanke, the yield curve inverted in 2006, 2007. And Bernanke actually was like, nah, it's all good. By the way, they didn't even start cutting until way after the yield curve inversion. Bernanke didn't see in 2006 the flat curve as a sign of impending slump. Mini inversion like last week can precede longer episodes. The yield curve just inverted. By the way, all of this is like absolutely brand new stuff. If you're not aware, that just came out today. Right. And again, I like to give credit where credit is due on here. Here's another one that just came out like a little over a week ago. The yield curve just inverted, putting a chance of a recession at 30%. Here's the fun part about this. And again, there's a real reason that I'm bringing this up. Now take a look at the interest rates. So as you're actually talking about the yield curve inverting, right? Here's the 10-year interest rates. So all we've talked about in 2018 is how rates are going to rise, rates are going to rise, rates are going to rise. Please, they're actually lower than they have been in 18 months. The 10-year interest rate is now back down. Okay, this is actually today to 2.48%, basically 2.5% on a 10-year. Are we having fun yet? Okay, because again, remember the S&Ps just a moment ago. Now, let's get into some really specifics because we're talking about interest rates. What could be impacted the most by those interest rates, right? Anybody? What could be impacted the most? Anybody, okay? So the bonds obviously are the interest rates themselves. Well, I was thinking to myself and I thought to myself, banks is actually a great one. Banks, I actually thought of housing first. Okay, so I looked at financials, and financials was so incredibly obvious, but I also wanted to bring up real estate. This is an article from, 12 hours ago. I actually cut and paste this. It's from CNBC. Again, credit where credit is due. That was actually today. Manhattan real estate sales fall for the 6th straight quarter. Longest losing streak in 30 years. Manhattan real estate is absolutely tanking. But there's actually something interesting about Manhattan real estate a lot of people are not aware of. Okay, the Manhattan real estate marketplace was actually propped up by one purchase. That one purchase was an individual out of Chicago named Ken Griffin, who bought a $238 million condominium. It's actually the largest real estate purchase ever done anywhere in the world. And yet, okay, that actually propped up the statistics of Manhattan real estate. It's pretty interesting stuff. Now we're having fun. Zillow, California's expensive housing market, even prices out the rich. Californians typically spend more than 30% of their income on housing. How many Californians do we have? Housing prices drop in tech-heavy Bay Area. Okay, sales slow as prices drop 16%. Again, all very, very recent. This is from April 1st. At the exact same time we're seeing this, and there's a reason, again, I'm bringing this up. So the interest rates are effectively dropping, and that's really good for housing. Take a look at the XHB. This is the Home Builders ETF. It's up 18%, people, year to date. 18% year to date. If you're unfamiliar with this, the S&P 500 is underperforming the home builders on a year-to-date basis. The S&P 500 is only up about 15% on a year-to-date basis. People, we're in April. We just got to April. We just got through the first quarter. We're outpacing everything, okay, that we should be. On a percentage basis, this is absolutely wild. Do you realize that the home builders, okay, and we could be on the edge, again, we are on the edge of a yield curve inversion. We're on the edge of a yield curve inversion. We did see the yield curve invert. It kind of flipped back a little bit. All of that is pushed aside. Do you realize that the home builders are outperforming stocks like Google right now? How can this possibly be if just a moment ago, you look at a yield curve inversion as a 30% chance of recession? Do you see that over there? By the way, this is a great one over here. Larry Kudlow. If you missed that, this actually came out over the weekend. Kudlow, this is really weird to talk about Larry Kudlow, has a point in calling for an immediate rate cut. Larry Kudlow this weekend called for a 50 basis point cut. Okay, how bad are things when Larry Kudlow is asking for a half a point? Now, put all the politics aside over here, which could absolutely influence him. Things are not good when they're actually calling for a rate cut at this point in time. If you don't buy into that, you think it's all political? Well, how about this one? This one just came out last week. This is the IMF. If you're not familiar with that, okay, the IMF, International Monetary Fund. Firepower is insufficient to respond to major new crisis, okay? And again, this is the Bank of International Settlements head. So what the Bank of International Settlements is actually saying that the IMF ain't got what it takes to get through anything right now. International Monetary Fund does not have sufficient lending capacity to respond, okay, to a major new emerging market crisis affecting several countries erupted. Now, the head of the Bank of International Settlements said on Thursday, this is just last week, BIS General, again, former head of Bank of Mexico, and I'll leave it to its own devices at that point. If the fund cannot do it, others will have to do it. Otherwise, the economic cost will be huge, he added. So I just wanted to throw this in because I thought this was kind of interesting, given the fact that we actually have several Fed governors now calling for rate cuts. We just had a rate increase less than basically a quarter ago, December. And here we are 3 months later, and they're actually talking about cutting rates. The 180 is absolutely shocking. Here's the last piece I want to give you. Quant funds. Now, this is a little bit older, okay, but it's still extraordinarily relevant. It's older because, again, this is something I just really key into. Quants, which is quantitative traders, find stocks need a better hedge than just bonds. Using multi-pronged strategy boosts volatility-adjusted return. A lot of hedges have disappointed, says PIMCO, right? The old recipe of using bonds to hedge against risks from equity holdings may not be a winner anymore, and investors would be better off with a more complex approach that relies on multiple tactics, according to, again, this is PIMCO, it's Pacific Investment Management Company. Again, that's from back in 2017. This, okay, is what we're actually going to reference tonight. All the risks that you effectively see out in the marketplace, okay, well, it boils down to just this. What do you do with holdings right now? And I want you to think about this. What do you do with your stocks? What do you do with your mutual funds? What do you do with your 401k? What do you do with your IRA? What are you going to do right now with those? when basically, okay, the bond capital of the world, which is PIMCO, tells you, okay, that what? Using bonds as a hedge ain't going to work. Of course it's not going to work. They're not paying anything. Decisions, they have to be made. What do you intend to do? By the way, these are not rhetorical questions. This is where people just get totally silent. What are you going to do with a 401k and IRA? What are you going to do if you own stock, mutual funds, right? And with all seriousness, I threw up some hideous news articles to begin with. But you know what? Check your baggage at the door. Set aside any preconceived notions on what you think is going to happen in the markets, what you think can happen in the markets. It doesn't matter. I don't want to hear it. Check the baggage at the door. When volatility hits markets, your risk has to be in check. Good risk management starts with the perception anything can and will occur. But can you handle if anything can and will occur? Like, think about that for a second. Prepare yourself for any event. I mean, how hard can that be? Markets can move up, they can move down, they can move sideways. Like, think about that for a second. It's not that bad. Now, anticipation of risk. All investments are going to have risk. Learning to deal with those risks that's that key step forward for people. Like, it's so easy for people. They just go out and they just go, well, you know, I'm going to go out. I'm going to buy some mutual funds. I'm going to buy some stock. And they tell me over the long run that crap actually goes up. Okay. That's great. That's the investment side of it. But most people can't deal with the risks, and not dealing with those risks is you're blind at that point. In order to manage, okay, your risks, we shall employ the use of options. I said the O word. We're actually going to use options, okay, to mitigate, or what we term control. So what are we going to do? Tonight, we're going to learn to hedge a little bit. We're going to learn to hedge. We're going to actually come into a core strategy and trade logic right here, right now. And today, I want to introduce to you, one, it's a real world strategy. Okay. The stuff that I explain, right? You know, I try not to get too much into the idea of like hype and so forth. The stuff I'm going to explain tonight, this is real world. This is a tactic that has been used, okay, for a substantial period of time by portfolio managers. It's a tactic, though, that just doesn't seem to permeate into the retail world. You know, what do you think hedge fund managers are doing, you know, when markets turn against them? Sitting there and just like, oh, this is going to hurt, right? We got to get to a core strategy and some trade logic, right? And that's going to be very, very risk averse. What we're going to talk about tonight, we want to reduce risk, okay? And we want to maximize returns. I mean, that's the name of the game. It always is the name of the game, but we've got to reduce risks and maximize returns. What if I could teach you one strategy, just one strategy, to allow you to remain in the markets with considerably less risk and still provide upside potential? Like, does that interest you? Because what I'm going to show you, it can be done in an IRA. It can reduce risk of a 401k, can be used to reduce risk of mutual funds. All right, come on, people, admitting it's the first step tonight. How many people here have a mutual fund? Anybody? Almost 1,000 people tuned in. Nobody's willing to actually come in and say, yes, just put a Y in. A Y, an N, an NA, not applicable, right? I mean, how many people here truly have like a mutual fund or a 401k? Like, what do you have? I mean, you tell me what you have, because we're going to talk about reducing risk of portfolios, right? And it's important that we know what you have. You could have a Roth, you could have an IRA. By the way, IRA, Roth IRA, it's all the exact same animal. You name an account, I'm familiar with it. I'm even familiar with the Canadian accounts. Listen, I was a licensed broker dealer for a whole lot of years, right? And we're going to talk about reducing risk of mutual funds, reducing risk of individual stocks. Can be used to hedge a basket of many stocks. It should interest you. It doesn't interest everybody, but it should. And this is the kind of stuff that we're going to talk about right now. Let's get into it. If you buy stock or have mutual funds, okay, the following is your risk. Now, I put up like what I call a little bit of a synthetic position. What I basically did is said the following position, okay, is the resulting risk of 1,000 shares. It's spiders, right? Spiders. So what are the spiders? Okay. The SPY is the equivalency of the S&P 500. How many stocks are in the S&P 500? It's a trick question because Google counts kind of as two. Anyway, this is equivalent to 1,000 shares of the spiders. Now, the spiders right now are about, a $286 stock. So if you have 1,000 shares, my portfolio right now is the equivalency of $286,000. That's what I just created over here, $286,000 portfolio. Now, the reason why am I using the spiders? Because the spiders has a very large, relationship with whatever your mutual fund is. People go, no, I have an emerging markets mutual fund. Which probably moves similarly to the spiders. No, I have a tech heavy, which the spiders are fairly tech heavy. I mean, I can go all day long. Like most people don't realize their mutual funds or their 401ks, they're kind of benchmarked against the spiders. I got a good question on this one too. How many of you just bought the spiders in your 401k? Huh? A lot of people do that. Again, 401k, IRA. But this doesn't necessarily have to pertain to just the spiders. This could pertain to an individual stock. Somebody was actually asking about currency. Sure, it'll work. It'll play, right? By the way, somebody was also asking here, aren't the spiders, volatile? No, I mean, the spiders are supposed to be not that volatile. I mean, it's the S&P 500, all right? So it's docile. Now, one of the things I want to talk about in here is this is a risk graph. This is what a risk graph looks like, and right here is where the spiders currently are trading. So if the spiders go down, this is how much you lose. If the spiders go up, this is how much you make. All I wanted to show you is if the spiders go down to 230, you're like, okay, right now they're at where? 286. If they go to 230, can they go from 286 to 230? Can they do that? Huh? Maybe. Okay. By the way, somebody was asking, what if you're in cash? Don't worry, we're going to actually cover that. Can the spiders go from 286 to 230? Anybody. Okay. If you're unaware, by the way, first of all, that's going to cost you $50,000. In this portfolio, again, this is a $286,000 portfolio. $286,000 portfolio. If they go down to 230, you're actually going to lose slightly more than that. You're going to lose about $52,000. Okay. By the way, that wasn't even a fair question. Can the spiders go to 230? They were there on December 24th, 2018, which is just about 3 months ago. So if you're like, nobody actually came in here and said, no, of course not. They were there. By the way, somebody actually came in and go, yeah, they were there in December. That is awesome. They were there in December. Would have cost you $50,000. A ton of people that are on tonight. And it's funny because we all have like the short-term memory of the markets. The markets are great at that, by the way. As soon as it's a new quarter, Wall Street's pretty smart. When it's a new quarter, they're like, start fresh. It's a new quarter. It's a new year. It's a happy new year, right? And we just heard over this past weekend, we're actually coming out of the best quarter in over a decade. Meaning that in a percentage return, the S&Ps and all the index products, they did better in the last quarter than they did in the previous decade. But I just want to remind everybody, because this is pretty much wild stuff. So in Q4, this was December, Q4 of 2018, the markets tanked. In Q1 of 2019, the markets rallied. Which was bigger? It was Q4 was bigger down than Q1 being up. Yeah, because Q4 2018 was the biggest down move we've had since the financial crisis. Yeah, so it's just fun with numbers over there. All I want you to see is the risk to the downside over here. That's it. I don't want people like this. The goal tonight is to get you to understand, like, listen, I was in the brokerage business for a really long time. I was there in 2000, 2001, 2002, 2003, okay? I was actually running an entire division of Thinkorswim when the financial crisis happened. I mean, we were on the phone with clearing firms. We had a $300 million hit in one day. $300 million. Do you think I want to see that crap happen again? I watch people lose half their life savings, okay, inside of like, what? A 3-month period of time. And then it didn't stop until into 2009. It was absolutely hideous. Okay. That's the goal tonight, is just to display your risk for a second. And then for you to rationalize this. That stops will not save you. Okay. Sure, you can use stops, but stops Are stops really going to get you out at a price you intended? Will stops be there to save you in the event of a major market correction in a short period of time? Can stops control risks in your 401k or mutual funds and most of your IRAs? Absolutely not. Stop with the stops. There is nothing definitive about using stops to mitigate risks. If you have a shock to the marketplace, what's a shock to the marketplace? One of the last really big shocks to the marketplace is in recent memory. Everybody kind of forgot December, okay? But it's a shock to the marketplace, and stop with the stops. And if you use stops back then, you got stopped out. Okay, what we're going to teach you, learn to lock in your gains. What if we could add a risk reduction strategy to your existing portfolio, okay, to limit downside exposure, lock in your gains, and allow you to keep most of the upside potential? The first thing, why are we not doing this? And this is stuff that, again, it's done every single day. The reason I brought up the 2017 PIMCO article is because PIMCO told you in 2017 that bonds, I'm going to say this as eloquently as possible, bonds are going to absolutely suck as a hedge. They are not going to work. Okay? You can't just be buying stock and holding it right now. You realize, okay, that the wealth of not just the United States, but the wealth of the entire world, okay, was coming to a crashing halt in December. And effectively, okay, they had to put the brakes on, and that's when they kick, Mnuchin, which is, Treasury Secretary, out there. He's like tweeting, come on, we're talking to the banks, everything's going to be fine. They were talking about liquidity and so forth at the time to actually bolster markets at that point. And yet people, they just don't think about hedging. I mean, why aren't we doing this? You're one trade away from this. What we're actually going to do is I'm going to teach you exactly how to do some of this tonight. This is the same 1,000 shares, okay, of risk on the spiders. This is the same 1,000 shares in the spiders, but we added the risk reduction strategy. Almost all the upside. Now you're going to give up some upside, but with extraordinarily limited risk. What I want to show you is this is the same 1,000 shares, okay? If the market were to crash, absolutely crash, you can't lose more than about $4,000. Take a look right there. Okay, that's what? Losing $0, that's losing $10,000. Here, you're losing about $4,000. Okay, that's it. The risk is actually definitively cut off. Your upside exposure, well, this is where the market currently is. You got lots of upside exposure. I don't know if you're happy with that, okay, but that's what we're going to go into right here, right now. And I'm going to show you how to what's called ratchet this up. So again, much of the upside exposure, almost none of the downside risk. That's what you're one trade away from right now. And it can be done in an IRA. And it can be done against a 401k. And it can be done even against a Canadian, retirement account. Welcome to the Atomic Hedge. The Atomic Hedge, okay, it's the purchase of put options in order to counter downside risks on a long portfolio, on a 401k, on an IRA, on an individual stock, or on a mutual fund. But the put options, they're expensive. They're financed through selling out-of-the-money call spreads. Sounds easy enough. This trade, though, you got to be precise. You have to be precise to absolutely counterbalance the individual risks. Below is an example of the trade. By the way, the trade, I want to make this abundantly clear right here, right now. This trade costs you nothing. It will cost you a little bit of upside potential. Did I say this again? The trade will cost you nothing. Okay, up front, this trade will cost you nothing. And that's why I continually reiterate, why are more people not doing this? It doesn't cost you anything. You're like, but I have to give up some of the upside. Oh my God, like the marketplace is at almost all-time highs and the yield curve is inverted. What is wrong with people? Like, I get upset about it because you don't have no clue how much risk you really have right now. None. I don't even have a clue what your risk is to the downside. But I can tell you one thing, looking at the S&P 500, it's huge. Pull up a 20-year chart. I'll do it in a minute here. Think about it for a second. It's absolutely huge to the downside. And you're like, but I don't really want to give up my upside. Or people are just too lazy to actually employ something that's fairly easy and straightforward. Here's exactly how to do it. Now, moving along. Assume the SPY is trading at 286. and we own 1,000 shares. Okay. By the way, the SPY is trading at 286. Look, any trading application is trading at 286. Okay. This is a actual trade taken. Okay. And I even waited to take these screenshots till late in the day so that they were absolutely pertinent. Okay. We're going to go out and we're going to purchase a 281 put. Now, just bear with me as I'm going to take you through a few examples, because what's important tonight is that you get this. We're going to turn around and we're going to buy, okay, you with me? A 281 put. We're going to buy a 281 put. Now, you guys tell me, for those of you that know nothing about options, by the way, don't worry about the price of the put because it doesn't matter because I'm going to offset it. We're going to buy a 281 put. You tell me, what does a 281 put give you the right to do? What does a 281 put give you the right to do? All right? By the way, somebody was mentioning that their IRA doesn't allow spread trades. Guess what? You need to move brokerage firms because there's been spread trading in an IRA since 2001. Want to know why? Because I worked at the first place that allowed it. Because we actually started that. You could trade any option strategy now inside of an IRA. How about this? You could trade futures in your IRA. You could trade options on futures now in an IRA. It's crazy. 281 put. What does it do? Gives it the right to sell the spiders at 281. And somebody goes, but I don't own the spiders. I don't own the spiders, Don. What do I own? Okay. I have a 401k, or I have an IRA, or I have some, I'll just call this a fund. I have some 401k or IRA or a fund, and those are isolated. Yeah, but you could still buy a 281 put. You could buy a 281 put because these 401ks and IRAs and funds, okay, if the market tanks, they're likely to tank too. So let's say that the market tanks. The market tanks. Now, the market right now is at 286. The market just starts to the downside, and the market goes all the way to 240. Okay? Now, you have a 281 put. That gives you the right to sell the stock at 281. You don't own any stock, so what do? You just sell the 281 put. What's a 281 put worth with the stock trading down to 240? Well, first of all, it's an ETF, but the thing would be trading for a minimum of $41. A minimum of $41. And yes, you're guaranteed to get at least $41. It'll actually probably be some more with some time value. But again, you're getting the difference between 281 and 240. So you get 41 bucks in your account, but you're like, but I still lost money in my 401k. You lost money in your 401k. But if you could do this in an IRA, you get to keep the $41. So what do you do with the $41 after the market tanks? I have an answer for that. You go buy more. Why not? People go, are you averaging down? No, I'm hedging. And when I'm hedging, okay, the money is mine. The $41 is mine. I can actually go out and buy more shares. Now, blank the screen really quick because I told you I'm going to teach you guys a lot more than you probably bargained for. So we go out and we buy this 281 put. The 281 put, again, gives us the right to sell the stock at 281. It's a hedge. It's definitive, okay? At 281, this is 281 on the screen, right there. Right there. You know what that does? You have downside, but after that, it'll flatline. You have no more risk after that. Now, the cost of the put option, though, it's formidable. It's a big word. So we finance it by selling call spreads. Now, selling call spreads, it's going to give up some upside. It absolutely is going to go. I can actually lose in this call spread. Okay. I can lose $4. You're like, I'm going to lose money. Yeah. But you actually own the underlying. Okay. So if the underlying starts to go up along the way, you'll give back $4. I don't care. The market keeps going up and I'm good. You have to give up a little bit of upside though to protect your downside. When is it a good time to do this? Well, I think right now, since the marketplace is at or near all-time highs, quite frankly, I think every time is a good time to do this because that's how unpredictable these markets are today. If you're looking at the marketplace on a day-to-day basis and you're reading the news, you're probably thinking, this is the most ridiculous disconnect I've ever seen in my entire life. Okay? You're hearing information out of China. China. By the way, I gotta throw this out here because on Monday, information came out about China. What was the information? Their ISM numbers were good. And that rallied the U.S. markets huge. By the way, I want to throw this out there for your consumption. Are you aware that the ISM number in China is a survey? Are you aware that China is a communist government organization? And when they do a survey, they actually have people come in, they go, so what do you think about the economy here in China? What do you think they're going to say? They're like, Oh yeah, it's really good. It's a really good economy. I mean, people are not seeing the disconnect. They're blind. Hedge, okay? This will protect the nest egg. And I can't stress it enough. This is what you want to do. Here's what it looks like when you put it all together, okay? Much the upside, but with limited risk. And again, these are the exact strikes. This is a trade. It's done for a penny credit. And I've told you, there's a little bit of give back. Remember I told you about that $4? There it is right there. You get a little flat area. But let me be clear about something. This is a real risk graph, right? This is how much you can lose. How much can you make? Well, okay, so you have a little bit of give back in here, but then it just keeps ramping right back up. In this little bit of give back, don't you think giving up a little bit of the upside is worth it to curb all those downside risks? If you can't answer yes, then we got problems. You got some problems at that point, because at that point you're blind. Again, when I say blind, you're blind to the risks that are apparent in the marketplace, especially with an inverted yield curve. Now, let me show you how this works in context. Context of what? Live market. This is the spiders over 1 year. Okay. If you're hedging in the spiders over the last year, okay, you're using this strategy, right? And you can actually incrementally use it to kind of lock things in. By the way, I don't know where a high or a low is. All I'm doing is drawing hash marks once a month. That's it. I am not timing the market, because people are like, when do you put this on, Don? Like, when should I do this? Actually, you know what? Let me change the color over here so you can actually see this thing. But people always ask me, okay, when do I put it on? Let's be really precise over here. I got news for you. I don't believe you can time the market. Here's a month, here's a month, here's a month. I'm just putting these things at these hash marks right here. Here's a month, here's a month, here's a month. Now, okay, this is 1, 2, 3, 4, 5, okay, 6 times. That's 6 months. Let's assume that you had to do this once a month. By the way, you don't. You could actually do this every other month. You could actually do it every 3 months. That's up to you. That's up to you. I'll tell you specifically what criteria to use. When I say criteria, with options, you got to know. Do I use 1 month? Do I use 3 months? Could I do this thing for 6 months? Like, I'll actually talk to you in a minute here about criteria. But assuming you're ratcheting up and ratcheting up. What I call it ratcheting up. Okay, so the market's been rallying. Do you realize that by buying these puts, you're locking in? When I say locking it in, you know, up here at 290, this is the all-time high of the marketplace. And if you just did it once a month, you would have been buying, okay, about a 285 put. And again, I'm not timing the market. All I'm doing is saying at the beginning of October, okay, you didn't try to time anything. October, you go, okay, it's time to do it. You buy a 285 put. Then what does the market do? Absolutely tanks. Okay. And let's say somewhere down here, what do? You have a 285 put. 285 put gives you the right to sell stock at 285. Now we're trading at 260. How much do you have? You just collected $25. All right, the market's at 260. Then the market rallies right back up and comes back. Look at this. Okay. You probably could have locked it back in over here at about 275. Then we absolutely tank. Okay. The irony is we tanked right to the end of the year. So here's the beginning of the month. And what did you do? Here's 235. From 275 to 235. What did you just collect? About another $40. You just took, okay, about $60, $65. Let's talk about commissions for a second. Cut the commissions out. Okay. Call this 20. Now you just collected $60. You have $60 that everybody else didn't have. Then the market explodes back. And what do? I hedge here, and I hedge here, and I just hedged here just once a month. Hedge, 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 hedge. Now, if we tank again, what are you going to do? You're going to collect more, and you're going to bring that money back, and you're going to go out and buy more spiders or more mutual fund. Okay? You think, again, it's worth knowing? Think about that for a second. This is actually what they call dynamic hedging. And dynamic hedging has been around for decades. It's been around for decades. This is being done, though, okay, only by it just doesn't seem to infiltrate to the retail trading population. Okay, this, by the way, what I'm showing you tonight, this is a portion or an excerpt of a course that I personally used to do for registered investment advisors. And I used to do that course because I actually built TD Ameritrade's institutional education back in 2011. All right. And there's articles written all over, the industry about, Don went out and built the institutional education. We were teaching them to basically hedge portfolios at that point in time. And it absolutely took off, caught fire, right? This is, again, by the way, you had to have $300 million under management or more for me to come out and actually discuss this with you. And this is the kind of stuff that they're doing. It has invaluable applications for the atomic hedge. That's what I call it. I call it the atomic hedge because it's, by the way, the atomic hedge, it doesn't have to do with like the atomic bomb, right? It didn't have to do with that. It didn't have to do with radioactive anything. It's just, it's an extraordinarily powerful hedge, and I couldn't, put together anything other than it's atomic. The atomic hedge, though, can be used to counter risks in the following accounts: a portfolio or basket of stocks. It could be done on mutual funds, individual stocks. Yes, you could do this to individual stocks, to 401ks, to IRAs, Canadian TFSAs. All right. I can show you how to do each and every one of those, even though everybody says, I can't touch my 401k. I know that. But I can actually still show you how to hedge it, either in a separate account. It doesn't matter. It's your money against your money. Okay, I could do it against mutual funds. If we know what is in your mutual fund, which, by the way, is required by law because they have to send you a quarterly prospectus, then you can hedge your mutual funds. All right, you can hedge it. And if people have mutual funds, I don't need to worry. My mutual fund is called a 2040 fund. I go, what's that? They go, when I retire in 2040, what? Are you going to hope that the market is doing well in 2040? What happens if you kind of catch like a bad decade? Catch a bad decade? It's crazy. I mean, why would you not hedge? Here's some of the characteristics of the atomic hedge. I believe the atomic hedge, the attributes are undeniable. You limit the downside risks while maintaining upside potential. The risk is limited to precisely your comfort level. You can dial this sucker in to anything you want. You don't need stop orders. The probability of profit is extraordinarily high. It's the perfect spread to reduce risk of a stock portfolio. It's an excellent tool. Okay, you're trying to build a smaller account or attempting to maintain wealth. I don't care what side of it. We're not paying anything up front for this hedge. Now, building the atomic hedge. You can't let options intimidate you. That's the one thing. It gets some people. I know that people tune in, to a webcast like this. And how many people are coming to a TheoTrade webcast for the very first time? You've never been to a TheoTrade webcast ever before. This is the first time you're coming to one. And they think to themselves, I gotta learn something. Listen, I know that everybody coming tonight, they want instant coffee and instant tea. They want to be handed something on a silver platter. They want red and green flashing arrows that's going to tell them what to buy, when to buy it. And if I tell you right now, nobody knows nothing right now. Not a thing. About why this yield curve inverted. They don't know what 6 months holds. And if you don't believe that, why don't you just listen to the Fed? Because they're telling you that. They're literally telegraphing and saying, we're going to hold rates totally flat because we're scared right now. That's what the Fed amounts to. By the way, they literally said that in a Senate oversight hearing where I shouldn't say scared, because that's not the wording. They are nervous as to what the future holds, as there is a global slowdown currently coming. Oh, by the way, markets were also basically at all-time highs. You got to understand, though, that this spread, this is like, the mother of all spreads. It's akin to a massive chainsaw. And use something like this correctly, it could be extremely effective in creating returns. It's kind of like a chainsaw. If you're going to cut down a huge tree, probably want to use a chainsaw. A handsaw is going to take you forever, right? But if you use a chainsaw and use a chainsaw incorrectly, you are going to lop off an arm, a couple of fingers. The same thing is true of this spread. You got to use this thing right. Used incorrectly, you may cut off a couple of fingers. You have to be precise in how you construct this. But at the same time, I don't want you to fear the atomic hedge. Maybe you don't have options experience, limited options experience. I don't know. Okay? How many people here do have some options experience? Huh? How many people here have some options experience? All right? No, a lot of people coming in. It's okay to say none. All right? If you have none, I get it. Now, we can show you precisely how and when to place the atomic hedge. It's a matter of a couple of hours. What we do here at TheoTrade, listen, everybody mentions they got, it's a secret squirrel strategy. It's this, it's that. I just gave you the strategy. What we do here at TheoTrade is we build recipes. It's criteria. We actually build a recipe of how to get into this thing. Every variable when you're in it. When I say every variable, what if the stock goes up? What if the stock goes down? What if the stock stays flat? I have a 401k, I have a mutual fund, I have currency products. What do I do? What do I do? What do I do? You wouldn't bake a cake without a recipe, so why trade without one? For this marketplace, you need an atomic hedge, right? This is the slide that I told you. Like, why don't you go open a 20-year, this is a 20-year monthly of the S&P 500. Most people down here lost over 50%. And I'm telling you right now, okay, I worked in the brokerage industry through this. I pretty much got hired in the brokerage industry right here. At the end of 1999, I was offered a position. I took it, okay? Market peaked out March of 2000, came slamming down. You know, in the first 3 years I was in the brokerage industry, I got to watch people that had, millions of dollars in some cases because they were involved in IPOs, lose it. They got crushed. And by the way, the people that had the IPO stocks, they had nothing left. They didn't lose 50%. They lost 80%. There was actually a company, I'll never forget this. There was a mutual fund. You go check this out. It was called First Hand Funds. They were a mutual fund that invested exclusively in technology. Guess what? People lost 87% of their life savings in first-hand funds. Then I watched it ramp up again. We warned people to hedge, to hedge, to hedge. And it came down. I mean, this was something completely different. I don't necessarily think we're ever going back into a financial crisis. I got to tell you, working at a brokerage firm, it scared the crap out of me. It should have scared the crap out of everybody. Like, this wasn't just as bad as you thought it was. Okay, there were days where I wondered, are we going back into the Stone Age? It was that bad. But don't worry, the Fed just did this. Don't worry, right? Look where we are right now. If this didn't scare you enough, okay, you think is it worth learning to reduce the risk? And again, people will tune in tonight, whatever, I don't even have, maybe you're in cash, that's fine. Because if you're in cash, don't worry, I'm going to show you some stuff, okay, towards the end of this. If this marketplace comes down, you're going to thank, okay, every single day your lucky stars that you actually had the atomic hedge on. Of course, everybody asks the question, why doesn't everybody do this? Why isn't everybody doing it? It's because here's what you need to know in order to use an atomic hedge. You have to know, and you got to be precise here, right? When I say you got to be precise, let's not mess around. You got to know how many contracts do I use against my 401k, right? How many contracts are you going to use against your 401k? Can I do this in a tax-deferred account? Yes. How far out of the money should the puts be? Okay. How many calls do I sell against my puts? What do I do when the puts go in the money? Should I worry about dividends? Dividends are absolutely huge. Okay. Do I need to actively monitor the trade? Can I set good till canceled orders? All of this. I mean, this answers the question. Why doesn't everybody do this? Because they don't have the answers to the questions. That's what we do here at TheoTrade. We just build recipes. It's criteria. It's what we do. When I say criteria, it's a recipe book. Because you're going to find out that trading is about answering questions. It's about answering the what-ifs. What's the correct options expiration for my atomic hedge? How much capital will I tie up? You got to tie up some capital in here. How much capital do I have to have? You can have an extraordinarily small account. What call strike options do I sell and how many? What strike options do I buy? Okay, how much risk can I limit my portfolio? Like somebody in here clearly is going to have a multi-million-dollar portfolio. How much? Well, TheoTrade is the answer to all your questions. Our recipes, okay, are going to look at all the angles of the atomic hedge. We will provide the following within criteria. We'll tell you what index product, ETF, or stock we could build an atomic hedge on. We'll tell you precisely what put options to buy, which call options to sell, the correct expiration cycle to build your atomic hedge. Okay, we'll show you the allocation model, whereby assisting you in selecting the number of atomic hedges you have to place in your portfolio, what to do in terms of order management. You actually got to build an order, manage the order, place hedges continuously, and never, okay, leaving the nest egg exposed. That's what we have answers to. We just build the recipes with definitive criteria, with checklists for each strategy. And more importantly, each unique variable that you're going to encounter. The how, the when, the why, at what price. It's just, I mean, literally, that's just the beginning of the variables you're going to face while using an atomic hedge. Now, the bottom line, the secret is in the sauce. You can read, I'm sure you can read somewhere on the internet, how to hedge. And people think that all the time. I could read about these spreads anywhere. Okay, probably won't find anything specific about the atomic hedge, but you could read about hedging. But the following strategy and the corresponding criteria, It's all about the utmost attention to detail. And we spent years fine-tuning this. I'm telling you, this is an excerpt tonight of a course that we taught to people that had more than $300 million under their management. Okay? You think we didn't spend time doing our homework? You think we didn't study 7 million accounts at TD Ameritrade? Right? We looked at everything. We looked at hedge funds. To generate this criteria is huge. Would you like the criteria to build an atomic hedge? This is a course. It's the Atomic Hedge Strategy Curriculum. We actually have a course called Reducing Risk and Maximizing Returns Blueprint. This is the curriculum. We teach you how to build the atomic hedge, right? So we actually have a course on this. We teach you exactly how to build the atomic hedge. Okay, why your retirement accounts are at risk of massive losses, how to reduce risk of 401k and IRA, right? Don't take chances. How to hedge the portfolio, okay? So you don't want to have a repeat of 2000 or 2008. Okay, how to maintain upside potential while controlling downside risks, the one strategy that's going to allow you to sleep at night. When to open it, when's the best time to close it. So you know, again, you're not going to be left guessing on the opening and closing, what strikes to use, what expirations to use, the highest probability of success. Everything it's a step-by-step workshop on how to systematically add this strategy to your trading arsenal. Here's actually the class itself. Again, it's called the Reducing Risk and Maximizing Returns Blueprint. We kind of call it a blueprint because that's the way that this particular course is laid out. Literally, okay, step-by-step blueprint. I is the trade instructor. This 3-hour course, it's actually about 3.5 hours. It is available immediately, okay? The level of detail in this particular course required, okay, that we go in, record it, cut, paste, edit, make sure it was absolutely perfect so it's ready. The course is ready. The class slide deck that includes the entry and exit criteria, it's available immediately for download. So what you basically do, okay, you're going to go into the course, you download the entire slide deck and kind of follow along. The class is also available on TheoTrade mobile. We have iOS and an Android application so that you can watch the course, okay, review the course, download the course onto your TheoTrade mobile application. By the way, the class also qualifies you for reduced commission rate. I want you to think about this for a second. Not only are we going to teach you how to hedge off a tremendous amount of risk in the portfolio, now we have 3 major brokerage firms, okay, that are in agreements with TheoTrade. TD Ameritrade, E-Trade, and Tastyworks, okay, all provide TheoTrade clientele an adjusted commissions schedule, okay, for those that attend courses like this. Why? Okay. Well, first of all, okay, listen, some of the commission rates vary from firm to firm. You feel free to ask inside of the chat room because some people have a TD Ameritrade account, some people have an E-Trade account, some people have a Tasty account. That's fine with me, okay? Again, the course qualifies you for reduced commission rate. I can't mention all the different commission rates while I am live. But I'm telling you right now, if the brokerage firms, okay, are behind us on something like this, you should be too. Now, everybody that's here tonight, they always think to themselves, we know! You've been there and you've done that. Now, how many people can honestly say they've been to, 10, 15 different webcasts? Because I feel like every single time people come out and they're like, this is a pretty cool strategy, but been there, done that. Like you've paid for a couple of courses over there. I mean, many of you tuning in this evening, okay, if you've just been through the gauntlet of paid classes and indicators and secret squirrel black boxes and red and green flashing arrows, there's so much crap out there. But only to find, just buy this one last thing to make all the difference. But wait, there's more. You got to go to a live class. You got to do a little dance. You got to make a little love. You got to get down tonight. Everybody's been there and done that. We've had it. We've had it at TheoTrade. We've had enough of the educational garbage, the sales pitches, and we're trying to put an end to all of it. And we're intending to put an end to all of it. That's why I put the t-shirt. Been there, done that. We're going to disrupt financial education. TheoTrade's built by professional traders. Everybody here has a minimum of 15 years of experience. We don't have any professional salespeople. By the way, when I introduced you to the crew, it was Jeff Bierman, okay? It was Matt. It was Corey, right? Brandon. Did any of them, okay? Tony Rago, Slim, okay? All of them have trading backgrounds. And nobody ever worked in sales. Nobody ever sold any courses. Brandon actually wrote the book, literally wrote the book for a $24,000 class that we did at TD Ameritrade. He didn't sell it. He wrote the book along with Jeff Bierman and myself. Okay. Then they hire a bunch of salespeople to sell that crap. I'm going to prove this to you. Educating you, it is our only goal. We're going to demonstrate that. And hopefully tonight we're going to show you that, hey, it's going to forever change the way that you view market education. And we introduce to you what is termed TotalTheo. It's just unlimited streaming. What is unlimited streaming? Well, first of all, let's start with this. We'll give you access to over 81 trading classes. Pretty big arsenal, right? 81 trading classes. Let me tell you something. Would you rather be overwhelmed or underwhelmed? I mean, you go out, you're going to pay for some education. Do you want to be overwhelmed? Do you want to be underwhelmed? Okay? Because I think a lot of people, they go out and if they have paid for education, they're always underwhelmed. Why are you underwhelmed? Because you go out there and then they charge you more, and then they charge you more, and then they charge you more. It's ridiculous. We have 81 trading classes available to you immediately, today, on demand, and on TheoTrade mobile. Now, those 81 classes, that's going to include the reducing risk and maximizing returns. Okay? That's one thing I have got to stress to you right now. It is going to include this class that I just discussed. If you want to buy the class, like, hey, I'll charge you $300 for the class, but it also includes the high probability class, guide to selling spreads, iron condor class, selling premium class, survive and thrive, day trading, E-minis class, covered calls class, the next big short, which is also hedging, essential skills for consistency in trading, the top 10 skills to growing a small account, pairs trading, and many more. By the way, this is only a small excerpt of the 81 courses that's available. You're going to have access to over $5,000 in just classes alone. That's to begin with. On top of it, we're also going to give you access to 59 proprietary indicators and scans. Now, okay, one of those, this thing cost us a small fortune to create, the auto expected move indicator, S&P 500 gravity points, RSI Laguerre, it's a Laguerre polynomial, Quantix, it's actually one I worked on, NQ levels, for those of you who want to trade intraday, a next generation squeeze indicator, okay? That thing is highly sought after. We're not, we don't charge individually for this. We're going to give you access to everything. It's 59. This is only a handful of them. It's another $1,800, okay, in indicators and scans. Now, on top of that, and this is where people get a little lost. On top of that, okay, we've got coaching, we've got live trades, and emailed trade ideas. We have a live trading chat room that broadcasts a minimum of 6 hours per day. You realize the entire trading session is only 6.5 hours. We broadcast 6 hours a day. We have traders that provide real trade ideas and real-time market insights every single day. I'm on there, okay, about a minimum of an hour a day. Most times I try to do about an hour and a half, 3 times a week. Most days, hour and a half. Thursday, Friday, usually do about an hour. We email you out trade ideas. We have 4 distinct trading portfolios. So a lot of people are like, well, I'm in cash right now. That's good. We have all the trades you're ever going to need, both bullish and bearish. We also have daily coaching sessions with timely topics. Last but not least, you can email us. We'll hit you right back on an email. Instructors directly answer your trading questions. Do you realize there are firms out there, they will charge a few $1,000s a month to have access to their instructors? We'll give it to you. It's access to over $2,000 in support, trades, and insight. Okay? Think about what we're adding up over here. Seriously, think about this for a second of what we're trying to provide. I'm going to put a nail in the coffin to what's being done in financial education. $5,000 in classes, $1,800 in indicators, $2,000 in support, trades, and insight. This is what our members saying. First and foremost, holy crap, I've been a member of a lot more, okay? More than anyone should of stock market education sites. None of them even come close to the amount of information on TheoTrade, okay? Hey, Don, great training tonight. I just watched the replay of the option strategy used. You validated most of what I learned in the past 9 months. Okay? And I'm preserving capital and making money, up 20% in 9 months. Not even close to my goal, but making money and not losing capital. That's a key. That's why I put this up here for tonight. You need to go back and listen to the last 6 minutes. We have this replay on here. I can't tell you how excited I am to finally found a trading community that's obviously based on real knowledge, openness, and integrity. In fact, I've spent the last 2 years searching for just this, and now feel that half the battle is won just finding and embracing you guys. It's $8,800 in classes, live trading, coaching sessions, and proprietary tools. It includes the Reducing Risk and Maximizing Returns Blueprint. Okay? 81 classes. We have new monthly classes. I didn't even mention that. We're going to hit a class once a month at minimum. We're actually averaging closer to 2 classes. We have a daily live trading chat room. I know you guys can't necessarily make that, but it's also archived 24/7. We'll email you trade ideas, trading indicators and scans, daily coaching sessions, email support, TheoTrade mobile. We have a discount for you tonight. This is called TotalTheo Unlimited Streaming. It's $297. You need to go now to TheoTrade.com/TTS. Again, TheoTrade.com/TTS. Again, this includes access, okay, to the course that we just discussed. I think that all of us would agree, just going in here to learn to reduce risk and maximize returns blueprint, that's the Atomic Hedge class, that alone is worth way more than $297. Okay, I'd have given anything to have learned this right from the get-go when I got involved in the markets. By the way, I didn't even mention this. $297, this will give you access for a couple of days. It gives you access for 3 months. Why? Because we believe with 81 classes, you need a little bit of time in there. Okay, the other thing is, you come into the chat room, tomorrow, I'll actually give you a hedge. I will literally give you a hedge tomorrow morning in the chat room. You go, I can't make it in the morning. I work for a living. It's fine. It's recorded. It's archived 24/7. It'll be in there. You can email me. Email me and say, I need an atomic hedge. Okay. I do ask that you listen to the course. Okay. Not necessarily today and tomorrow, but in the next couple of days, email me. It's just support@TheoTrade.com. All right. Support@TheoTrade.com. Everybody knows that. Support@TheoTrade.com. Okay. As long as you, right, are enrolled for TotalTheo Unlimited Streaming, it's $297. I'll support you in every way possible. Again, it's TheoTrade.com/TTS. People always ask this too. They're like, do you really email back yourself? Yeah, I email back myself. Okay. I think today I did about 37 emails. Wasn't crazy. By the way, we have 3,300 and change members, but we have 7 people that are answering those emails. Actually, if you include our support staff, we have a few more than that. This is the stuff I'm telling you, people, you need to learn. Let me actually take you in and show you a couple of different aspects, okay, of the TheoTrade site. Actually, before I even do that, I want to show you this. Members are saying TheoTrade's the best service out there. If there's ever, okay, if there's anyone is interested in trading, got to get that out right. I always tell them about TheoTrade. You guys are the absolute best. That's just the way how I feel about it, okay? I've learned so much from you guys. Thanks for everything you do. And please, I actually do take this stuff to heart. I hope you guys recognize that. By the way, we're here to actually support you guys. This is the email address, and I wanted to throw it up here right now. So this is TotalTheo Unlimited Streaming. It's a subscription service. It's $297. I'm going to answer all your questions here momentarily. Again, the web address to get there. So while I go through this, it's TheoTrade.com/T. That's Tom Sam. Okay, TheoTrade.com/Tom Sam. This is our support email address. That will go to me. If you need an atomic hedge after today, email me for it. Now, let me show you a little bit about TheoTrade. This is our member chat room. This is actually a video streaming. This is where all of our clients talk to one another. Okay. Like talk on chat, lots of laughter. Anyway, there are any given day, 2,000 people that are in here. Again, we have over 3,000 members. Not everybody can tune in every single day, all day. By the way, if you know nothing about options, we have a Start Here series. What does Start Here mean? It means I need to start somewhere, right? Let's go to the Start Here. Start Here, Options 101, Options 201, because some people are just brand new. They don't know the basics yet. We have the basics. That's okay. If you want to know something about Think or Swim, we have TheoTrade tutorials on Think or Swim. Somebody was actually asking about different classes. Okay, there's 81 different classes here. Option strategies, technical analysis, day trading. Again, it's a little bit overwhelming. This is a hedging strategy that we're talking about tonight, right? The blueprint. But if you need to know option strategies because somebody said, hey, this is what I'm looking for, but I don't have anything right now. I'm in cash. If you're in cash, I'm telling you, you want access to this archive. By the way, there was a great question that just came in here, and I'm going to just go after it right now. In fact, I'm going to jump into the questions right here, right now, while you guys are kind of firing in some of those questions. I'm actually going to throw up the address again. It's TheoTrade.com/TTS. And it's important that you know, again, add to the cart. First of all, it's $297. That's for 3 months. Okay. Is it a teaser rate? Absolutely not. It's $297. After 3 months, you want to continue with this? Go for it. If you don't, we totally understand. Okay. We'll part ways. By the way, every single person that ever leaves like TheoTrade, I email them personally. Why? Because it matters to me. Like, I know I'm not going to give you a hard time. Like, well, I wish you the best. I wish every single one of you the best. Okay. But we find, and we don't do 1 month anymore. We find you gotta be immersed in this for 3 months. Like anything you do, you gotta be immersed in it a little bit to make it a habit. I'm not telling you have to spend an hour a day on this, but I am telling you, yeah, you gotta look at some of the stuff that we have from time to time. It's $297, not a teaser rate. If you want to do it for another 3 months, another $297. This is the Netflix of services. And it's all streaming technology. You can stream it on your mobile app. You can stream it on your computer. You can stream it on your iPad. You can even stream it on an internet-connected TV. Everybody's got one of those. You have a Roku, right? You can actually fly it up to there from your mobile device. It's easy, okay? It's easy to do. Now, again, that question has already come up into the chat room, so I'm going to throw it up there again. Let's make sure everybody sees that, okay? So the question that just came in is it a subscription? $297 for 3 months. It is, but you can cancel anytime. Okay. Can I get out of TheoTrade? Can I stop? Yes. Okay. $297. That's it. If that's all you want to do, I get it. Okay. Next thing, I'm having difficulty getting approved for options inside of my IRA. We can help with that. We can absolutely help with that. Again, we have relationships with TD Ameritrade. Remember, I spent 15 years in the brokerage industry. Okay. That's why, the knowledge that we're giving you tonight, and in these courses, this is not something that, I was a school teacher, I grew up in this, and listen, I grew up around traders, all right? I had family that traded. I got invited to Chicago. I've traded and been around traders my entire life, okay? The criterion stuff that we're giving you is tried, true, and 7 million accounts we went through and studied to come up with some of this criteria. It's huge, right? The relationship with the brokerage firms, you're going to find invaluable. By the way, you can trade all the strategies inside your IRA, okay? If you ever can't make a live class, 100% of everything we do on TheoTrade is archived. It's all archived. In fact, one of the things I wanted to show you on this site over here that I think is also kind of invaluable as you scroll down, right? Here's a sample of some of the courses that you go through, right? This is just some of the courses. You're like, oh, it's overwhelming again, okay? It just keeps going and going, right? We have up your level education over here. But again, here's the discounted rate. TD Ameritrade, E-Trade, right? Tastyworks. It's all part, again, of TheoTrade. We try to be your one-stop shop. You ain't going to need anything after this. If you do, okay, you tell us. We'll cover it for you. All right. So, by the way, we also, again, have mobile applications. You can check it out in the app stores. Somebody else just said I can never get my head wrapped around options. Well, that's why we have the entire Start Here menu. Okay. So, by the way, if you don't have that much time because you're working full time, we totally understand. We have an entire portfolio. Let me show you something really quick here. So go back to the site for a second. Portfolios. We have entire portfolios, like a duration portfolio. This duration portfolio, fruit fly, growth of a small account, sell premium. These are 4 different portfolios. The duration portfolio is totally hands-off. Why do we do that? We do a hands-off portfolio because some people work for a living. That's okay. I get it. All right. Next thing, somebody said, can I access Don in the future? Yeah, support at TheoTrade.com. Just put my name, just put Don in the heading of that, and it's to go right to me. This is another great one over here. How much time does it take to learn to use the Atomic Hedge? You know what? I think almost everybody can actually learn the Atomic Hedge in the 3.5-hour class. But I emphasize that you need to go through the 3.5-hour class. It's got some twists and turns you guys will find really interesting. And I'll tell you, $297, okay? That class alone is worth a couple of grand to you. I just want everybody to think back, what would it have saved you, okay, in terms of just sleep? Forget about money for a second and sleep if you had this just back in, October, November, December. It's absolutely huge, right? Now you talk about money. Some of you probably would have saved $50,000, $60,000 because you bailed out at the worst possible time. When you're hedging, you don't have to bail out at the worst possible time. With that, again, I want to thank everybody for joining us tonight. I hope I got most of your questions answered. We have tons of people that are in the support staff right now. Again, it's TheoTrade.com/TomTomSam. Okay, TheoTrade.com/TomTomSam. Thank you guys very much. Have a wonderful evening. Bye-bye.